Today's session delivered a powerful rally in U.S. equities. SPY and QQQ both closed strongly in positive territory. At the same time, the 10-year Treasury yield barely budged. That creates a divergence that most traders overlook. Usually, in big equity rallies, we see a meaningful drop in bond yields as investors move into risk assets. But today's move lacks that confirmation. In this video, we break down what this might mean for market sentiment, macro drivers, and possible risk ahead. We will walk through TNX, SPY, and QQQ, and connect this price action with today's key market headlines that may have influenced investor behavior. Looking at the 10-year Treasury yield, we see it closed near 4.206%, barely changed on the day. Intraday, yields showed a mild uptick early, then consolidated sideways with no breakout. Contrast that with strong bullish price action in stocks. That's a divergence. Why does it matter? Because bond markets often act as the macro thermometer. When yields slump, it signals fear. Traders want safety. When yields climb while stocks rise, it signals confidence. But flat yields with strong stock gains indicate something more complex. Investors are rotating into equities based on selective sentiment, not broad risk demand. The market may be interpreting recent data as good enough without signaling easier monetary policy. Traders are still believing that rates stay higher for longer. In recent news, several Fed officials reiterated that current policy is on hold, no imminent cuts, but economic data remains mixed. That keeps yields in a range rather than trending lower or higher decisively. This lack of yield direction is a caution flag. We need stock moves to be confirmed by bond markets to sustain long trends. SPY closed around 696.6, up nearly 1.9% on the session. Price action shows a clean, measured rally from the open straight through to the close. Compare this to neutral or sideways bond action. Stocks are clearly winning today. What drove SPY's rally? Today's headlines highlighted stronger than expected retail sales and consumer resilience, which lifted broad market sentiment. Investors responded favorably to signs that economic growth is stable, even without rate cuts. This kind of news typically boosts cyclical and broad market exposure. Another factor is positioning ahead of corporate earnings. Some large-cap companies are beating forecasts, reducing short interest, and supporting upward momentum. However, the fact that SPY is up without yield support tells us sentiment is technical and positioning-driven, not macro-confirmed. This is important. If yields break higher while SPY pushes up, the rally is robust. But if yields roll over or spike, today's gains may unwind quickly. QQQ was even stronger, closing near 609.65, up over 2.1%. Technology and growth names led the session. The price chart shows a steady climb throughout the day. Buyers were in control. Why tech today? Today's news cycle included positive guidance from major cloud and AI-related companies, suggesting continued investment in technology even amid broader macro uncertainty. However, markets are watching margins closely. Some tech earnings are beating on revenue but revising guidance on profit margins, so QQQ's rally may reflect demand optimism, not confidence in earnings strength. This is consistent with the bond message. Tech demand lifts growth names, but bond markets are saying not strong enough to change rate expectations. Here's what matters from the latest headlines. Fed speakers maintained a data-dependent stance, no strong signal toward rate cuts. This keeps yields flat and equity gains sentiment-driven, but not macro-confirmed. Consumer data surprised on the upside. Retail sales and services data pointed to resilience in the economy without spiking inflation, which supports stock bullishness. Tech guidance was mixed. Revenue strong, margins questionable. Investors rotated back into QQQ, but this type of flow can change quickly if margin outlooks deteriorate. These factors together explain why stocks are up without a clear signal from bonds.